Central bank independence. It might sound like a slightly abstract concept, but as we've seen in the increasingly tense relationship between the White House and Federal Reserve Chair Jerome Powell, the independence of monetary policy isn't something investors can take for granted. History shows us that parts of a financial system that once seemed permanent, take the gold standard for example, can unravel when political and economic pressures build up. So today we're asking, could the same be happening to the modern model of central banking? Well, to answer that big question, I'm joined down the line by Fidelity's global head of macro and strategic asset allocation, Salman Ahmed. Salman, welcome. Let's start with where we find ourselves today. Could you talk us through the current relationship between the White House and the Federal Reserve, and perhaps why markets are watching this so closely?
We saw how powerful central banks can be post-GFC. The tools they can create and implement have far-reaching impact on the financial system, on the trajectories of economies, especially when you're talking about the bond market, but also more generally with the economy and the entire setup. And that's why we are all focused on it.
We tend to think of independent central banks as a foundation stone of a well-functioning economy, but they haven't been around for that long, have they?
There's no clear template for the intensity of this, for sure, obviously, but we live in modern times now, and political norms are changing quite fast. But central bank independence itself has been a spectrum. No central bank is truly independent. Ultimately, they are answerable to in the U.S. case, to the Congress. But on that spectrum, we are moving away from the more independent side of part of the spectrum towards more pressure and dominance of fiscal policy on monetary policy. And this is not the first time it has happened. Central bank independence itself is a newish concept, really took hold in the mid-90s. RBNZ, or the Central Bank of New Zealand, was the first one, and then a big push came through when Bank of England got the inflation target. But there is a history behind that. But we are moving from the more independent part of that spectrum towards what is more a contested space, if you will.
And I suppose if we think about the gold standard, was often seen as another rules-based monetary system. Governments even suspended the convertibility in wartime or in moments of crisis. The lesson, I suppose, is rules hold until political reality comes to the fore. So my question, Salman, is what do you think happens next?
So I think the template is a bit different as well, because there's no one price law in place. So it's not like a fixed exchange rate model we're talking about, which itself builds that tension, if you will, especially if politics moves out of favor of those of the constraints those rules put on the political manifestation of power. But in this case, I think this is more of a spectrum, and we are going to see more and more moves towards it. This didn't came out of nowhere. There were a lot of question marks already after GFC on central banks' pre-GFC behavior and the obsession with inflation as the sole target. They forgot about financial stability at that time, and then it reverted back to a more interventionist approach by central banks. Even then, politicians started arguing that central banks are now going in the direction of becoming a political beast, in the sense that their decisions are having political outcomes. So there's been a number of things leading up to what we're seeing right now. But what is different is now it's turning into episodes. And more, direct confrontation between, especially in the US.
I like the way that you put it as a spectrum. There definitely is a range, isn't there, of the sort of the more independent, less independent central banks. And it's been said hasn't it, that the ECB, the European Central Bank, is the only true independent central bank left. Do you agree with that statement? Do you think that could change?
I mean, I think if you compare it with the Federal Reserve, then obviously Federal Reserve has more pressure from the current administration on it. But it depends on the next Fed chair as well. Is it a cyclical phenomenon right now because of the current political climate, or it has longevity? Because if the next Fed chair comes in and starts to reset the mandate, I think that would be a very important, far more profound change than some cyclical dovishness, which may come in as a result of the current political environment. In terms of the ECB, I mean, yes and no. I mean, I follow ECB, has been following the ECB for many, many years. During the debt crisis, there was a lot of political pressure on the ECB as well. And what Mario Draghi did at that time was seen as political intervention by some. Currently, it may seem that the political climate is not as hostile towards central banking in ECB, but I wouldn't take that for granted.
It's not a given. If central bank independence weakens and debt levels stay high, what might that mean on a global level? Do you think?
In fact, central bank independence or loss of it or reduction of it, let's call it, can actually help with debt levels because then you can run higher inflation, and then through that higher inflation, you can then take those debt levels down. But at the same time, the main lesson of history is that higher inflation is also volatile inflation. And the recent history, it's the 70s and the 80s that if inflation gets out of control, then you need actually to have to take a lot of economic pain to bring it back. In the case of US, you needed at least 2 recessions to bring inflation back to much more, tolerable levels. And also, inflation is a political variable. It's actually the variable I think can destroy democracies, and it can destroy autocracies, because you need the permission of the governed, no matter what the design of the governance structure is. And inflation high and volatile inflation can really damage that. So it's a tight path. It can help if inflation goes up, but it can also backfire spectacularly if it gets out of control and then starts damaging the social fabric, as history has taught us.
So some enormous repercussions there that you cite around inflation. So that savers losing their purchasing power. What other risks might we consider at this point? Are we capital misallocation, asset bubbles? What else should we be watching out for on the horizon?
So right now, obviously, we are looking at the long end of the curve. Steepening has been our base case for a couple of years now, because we thought that this fiscal appetite for fiscal deficits is not going to go away anytime soon. In fact, the political climate was moving in that direction for some time now. It has accelerated for sure. So the long end volatility in the US is going to be an important variable. The spillovers to the dollar are going to be important. So we think and continue to think for some time now that we are in a multi-year downward trend in the dollar. So I think all these dimensions we are talking about feed into that. But at the same time, US is a reserve currency, so that differentiates the US from the UK, for example, or Europe to a certain extent as well, which is that the Federal Reserve has immense power to control the entire bond curve if it wants to. So we've done our homework on yield curve control. We know how it works. There are already signs of that happening because the U.S. government is now issuing more on the short end, but that means the steepening, remains our base case. And then lastly, what are the longer term implications of it, which is higher for longer inflation, and potentially a stressed risk of a stressed Fed environment, which can create episodic issues as well as much as long-term trend issues. So multiple dimensions we're looking at, and we are feeding it into our capital market assumptions, and also underpinning our SAs or strategic asset allocation frameworks through that.
Thank you, Salman. I think the takeaway from this conversation is that central bank independence, it's not a law of nature, it's a policy choice shaped by history, politics and economic pressures. And as with past monetary regimes, investors will do well to pay heed to that. Well, we'll leave it there. But if you want to read any more on this topic, you can find further views and commentary on your local Fidelity website or at fidelityinternational.com. You can also hear how our portfolio managers are navigating these challenges and why emerging markets are rising up the agenda for investors. All that on the previous episode of Fidelity Answers, which you can find in your podcast app of choice. Thank you to my guest today, Global Head of Macro and Strategic Asset Allocation, Salman Ahmed. The producers are Patrick Graham and Charlie Humphreys, with production support from Connor Bailey and Adam Sheldrake. For now, from all of us at Fidelity, goodbye.